Hi everyone, welcome to The Noble View with myself, Michelle Segal, and Daniel Millman, CEO of Noblestone Capital.
Thanks, Michelle. We here at Noblestone Capital have been looking to work with Michelle for a good while, but then this worldwide pandemic kind of got in the way and it messed up international travel. But we're really excited to be able to do the Noble View, so let's get started.
So, does the US economy need another stimulus bill? And will we see one now that the election is over?
So we certainly need some sort of fiscal stimulus, right? The US economy is largely based on consumer spending, and that spending has taken a large hit during the pandemic. Now, during 2020, a good amount of that spending was supported with the CARES Act, with the first stimulus bill, but that's soon going to run out. So in order to keep up GDP, in order to keep up the level of consumer spending, at least close to a line that supports our economic growth, we definitely need more stimulus. Now, when that'll happen is a good question. I think that it will happen. Maybe in 2020, probably not. More likely in 2021 after the administration changes. But I think that we will see a stimulus bill. Now, in a blue wave scenario, had the Democrats taken in control of Congress as well as the presidency, so I think that we would have seen a very large stimulus bill. And then the question would have been, would that become inflationary? I think the question now moves more to whatever stimulus bill is passed, will it be enough? And we see it as we probably need something like somewhere between 1.5 trillion to 2.5 trillion in stimulus. But even if, for example, we saw a $1 trillion stimulus bill, which wouldn't be sufficient to make up for lost spending, for lost income, it would certainly go a long way.
That's great, that's really interesting to hear. There's a lot of talk about potential gridlock in Congress. Is that a good thing or a bad thing?
So that's a really interesting question. First of all, obviously, political gridlock assumes that Republicans maintain control of the Senate, which is far from a foregone conclusion at this point. But I still think that's our base case. I think we still believe that has above a 50% probability. So we're going to go with that. And obviously, if things change, we'll update our expectations. In a situation of political gridlock with a split government, not much gets done in terms of legislation, which might sound bad, but from an investment perspective, it actually might be a good thing. Historically, for example, markets have performed well in situations where you have a split government. And I really think that's for two reasons. First of all, when you don't have extreme legislation or surprise legislation on the table, the business environment stays more predictable. And business owners are able to operate in an environment in which they're more comfortable, number one. And number two, the legislation that does tend to happen is more bipartisan when you have gridlock. And bipartisan legislation is typically more economically friendly than legislation driven by ideology when either party is in control. So really for those two reasons, political gridlock from an investment standpoint might not be such a bad thing.
Great. So will a Democratic administration loosen the trade war with China?
So there are still intellectual property issues with China, and I do think that a Biden administration will continue to prosecute that. But I also expect a loosening of tariffs that were put into place over the last few years, and I expect China to reciprocate. What that'll do is it's really a positive for global trade, so I think that's a positive for markets. It also should have the effect of weakening the dollar as we continue to increase our trade deficits.
So what do you think the Federal Reserve will do now?
So assuming again that Democrats don't take control of the Senate, I think that results in much less fiscal spending over time if they had. And therefore, the Fed has to take a more active role in supporting the economy than they would have as the pandemic winds down. So the Fed's interest rate tool is basically used up. The Fed funds rate, the overnight rate, is almost at zero. So their help would come in the form of quantitative easing, QE, meaning when they purchase bonds on the open market. This will have the effect of lowering interest rates and keeping them low. I think that we stay in a low interest rate environment for 2.5 or 3 years or more, which also has the effect of further weakening the dollar with lower interest rates.
So Daniel, what are your major economic outtakes from the election?
So it's really three things for me. First of all, I think the expectations with a blue wave was that there was a risk of inflation running very hot with a lot of inflation over time. And I think that's much more moderate at this point because we don't see as much fiscal spending as we would have with a blue wave. That's number one. Number two is lower interest rates, as we just mentioned. I think, again, the Fed is going to have to take a much looser monetary policy stance over the next few years than they would have if there would have been more fiscal support to the economy. And that'll keep interest rates lower for longer. And number three, it's a weaker dollar. Again, from a loosening of the trade war as well as low interest rates, I think we result in a weaker dollar.
Thanks, Daniel, for your time. And how will this affect investment assets and markets? Stay tuned when we meet again on another episode of The Noble View.